What would you do if I offered to sell you a massive gold mine at a massive discount? That's kind of the question today. Today, we're going to be talking about a company called Barrick Gold. It's a Canadian company headquartered here in Canada, worldwide, very big name in the gold mining space. And if you've been following the gold mining space at all, or even just the price of gold, you would expect this company to be doing amazing. Problem is, it's not. They have barely gone up over the last year, and somehow they are managing to be dramatically outcompeted by all sorts of smaller peers. So in this video, my main question, is it worth buying Barrick Gold at this discounted price? Welcome to Golden Arch Investing. My name is Liam, and on this channel, we love to talk about Canadian investing. Today's topic, big Canadian company, a really interesting story. If that's something that interests you, please do subscribe to the channel and like the video. It means a huge amount and doesn't cost anything. I'm going to split this video up into a couple of parts. First, I'm going to talk a little bit about Barrick Gold, not too much. I'm going to talk about what's going wrong. So what is it that has caused these problems from a sort of bird's eye perspective? Then I'm going to compare them to one of my favorite gold mining Canadian companies, Agnico Eagle, which we've talked about here on the channel. I'll link that video below, but we'll just compare the two. And then I'm going to talk about what I would do if I was offered to buy this company, or in real life, if I had the opportunity to buy the stock at the current discounted price. So let's start. To start off, Barrick Gold is a massive gold mining company. Once upon a time, it was fighting to be number one in the world of gold mining. Today, it is a distant second, coming up on being the third, with Agnico Eagle maybe passing it, and with Newmont well in advance. So this company has fallen behind pretty badly over the last couple of years, but there's a big question. Why? If you look at the price of gold, if you looked at a stock chart of the spot gold price over the last 10 years, you would expect gold mining companies to be doing amazing. Typically, when the price of gold increases, a gold mining company that has the same or similar expenses mining the gold would then have a higher profit margin because the exact same material that they're mining out of the ground is now worth an awful lot more. And so you'd expect to see revenues going up, you'd expect to see profitability going up. And that's kind of the goal of investing in a gold mining company, is that if they can do a good job, if they can be efficient, they can pick good properties, they can do a good job operating the mine, you're going to see great returns in the long run as they have all this extra cash and they either reinvest in the business or they pay out shareholders. It can be buybacks, that can be dividends, whatever it is. It's usually a great thing to hold, particularly in my kind of position where I'm interested in investing in these Canadian resource companies. Barrick, however, seems like they've missed that memo, and instead they've struggled a huge amount with efficiency. They have blamed efficiency problems in Nevada, efficiency problems in other mines around the world for their sort of overall challenges. And there's also this big geopolitical problem. And specifically, if you've seen headlines in the last couple of weeks about Barrick Gold, it's probably about their problems in Mali, which is an African nation that has recently had a transition from a civilian government to a military one. And the military government doesn't like these guys. So them having mines in countries that are maybe not quite in the ideal sort of situation to be investing millions and millions of dollars operating these huge gold mines in, obviously puts them at risk. And it's a risk that investors have to take into consideration when investing in the stock. So now that we've kind of talked a little bit about what's holding them back, their efficiency problems, the geopolitical problems, let's compare them to Agnico Eagle. Well, there's a couple of numbers that I think really do demonstrate just the difference between these companies. And I'm going to be talking a lot about growth because in reality, when we're looking at a stock price, we're looking at basically buying their growth, right? We're usually paying a multiple on what they're earning right now with the expectation that these companies grow and earn back enough money that multiple becomes smaller and smaller down the line. So I've got some notes on the screen right here beside me. Agnico Eagle, we're looking at and I'm looking on FinChat, shout out to them, but I'm looking at a revenue increase, compound annual growth rate about 16%. That's awesome, right? That's okay, maybe not quite in line with the last couple of years of the S&P 500, but double the average return of about 8%. And that's in revenue compound annual growth rate. That means they're up 300% revenues in the last 10 years. Now, if I drop down to Barrick here, I'm looking at a compound annual growth rate of 1.9%, and they're up about 20% in revenues over the last 10 years. And you might be thinking right now, sure, okay, right? Revenues have not grown as much for this company as they have for another, but that doesn't really mean much. You can have massive revenues and still make very little profit. Or you could have small revenues and have a huge amount of that be profit. So let's jump over to some profitability numbers. Looking just at gross profitability. Gross profits, the top of the profitability lines here on FinChat. Agnico Eagle's looking at 18.6%, which is even better than that revenue number. It looks like they've been able to capture some of that efficiency from the gold price going up over the last 10 years. A massive total increase. Those couple of percent have led to a massive total increase of 430% in the same time frame. So revenue's up 300, profitability up 430. So bigger profitability number than that revenue number. That's what I want to see, right? That's what I said I would expect as the gold price goes up from a gold mining company. Okay, we'll drop down to Barrick here. Okay, now this is the problem. Look at that, 1.9% compound annual growth rate, 20% gain over the last 10 years. Now, looking at this chart, right, we're seeing some ups and downs for Barrick, right? A little bit more volatile. They've been had some up periods, they've had some down periods. They're sort of on an up period right now, but still, just look at the difference in these numbers, right? Not quite, but almost a tenth every year as much growth in profitability as Agnico Eagle had. And obviously, if you're looking at their revenue numbers and their profitability numbers back to back, they're almost identical. So you're not seeing that same amount of increased profitability, that same increased efficiency from Barrick that you're seeing from Agnico, which tells me that it's not an industry-wide problem. It's this company specifically that's suffering. One of the things that I had been questioning was, okay, maybe they've had these problems over the last 10 years, but that's a sort of backwards looking metric. Looking forwards, am I expecting things to get better? There's lots of companies that you can be buying at this point as a turnaround play. I've done it before. Could I be looking at them as a turnaround play? Well, I dove into a little bit of what people online have been saying about them and what management has been saying about their future. And I don't know that I'm all that impressed. Now, they have done a couple of things that I think are definitely interesting and worth looking at, but none of it has fixed that sort of fundamental problem that they're not being more efficient. They have not managed to capture that efficiency, and they've put themselves in a geopolitically risky position. So what exactly have they been doing? Well, they've been diversifying. Now, as an investor, I love diversification. We talk about it here all the time. We talk about the value of ETFs and the value of sort of geographic and sector diversification in portfolios. But if you're buying a gold mining company, I don't know that diversification is exactly one of the things you're looking for, right? If you're buying a gold mining company whose main focus and the vast majority of their revenues are from gold, you would probably expect that company to just do that thing well. And when their things are up, things are up. When things are down, they're down. And you just ride through the cyclical waves like most commodity-based companies. Well, these guys are diversifying into copper. Now, copper is definitely an interesting resource to be mining more of, right? We're talking energy transition. We've talked about it a bunch on this channel. I've talked about wanting Canadian companies to be mining energy transition materials and how that will probably bring sort of a boost in Canada's economy. It'll provide some great opportunities for us investors. I don't think this is the company that would want to do that. This is a giant brand name company, a big gold miner that has gold in the title. And their gold mining operations are not running as efficiently as they should be. Even management has admitted this. They've talked about it specifically. I'm thinking Nevada. They've talked about that, how it's not run as efficiently. I would expect that this money that they're using, this sort of capital expenditure money that they have, this CapEx where they can be expanding and doing things and building things and creating new projects, probably could instead be used to improve infrastructure in mines like the one in Nevada and sort of just consolidate and improve their core business, allow it to become more profitable, capture some of this delta as the price of gold goes up. Instead, they're investing in copper, which might be a genius move long term. But from my perspective right this moment, it seems a little misguided. When you're already struggling to do one thing, trying to do two sounds like more of a challenge than it might be worth. Now, obviously, that could be changed in with a snap of fingers. And if management decided to change their mind, if they saw metrics that that confirmed to them that actually they do need to be spending their money on themselves. And this is where I got to some of the readings that I had done really concerning me, because when digging into sort of how these mines operate and all the different companies that are involved, one of the things that I had seen was that actually Barrick can't invest their way out of the problem. Some of the operational problems happen because multiple companies are working at these mines. So it might be a Barrick owned mine operated by someone else, or something of that sort of variety where there's other companies involved. And Barrick is not able to create more efficiency because of all these different relationships with all these different companies. Now, if that's the case, then there's no real way for them to invest their way out of the problem, even if management decided that that's what they wanted to spend their money on, which is an even bigger red flag for me. So let's jump down into sort of my conclusion here. What am I thinking? Am I going to be buying this? Is it worth it? To understand this, I just want to focus on one metric. Again, on FinChat here, we're talking PE. Now, the PE ratio right now on Agnico Eagle, and obviously it's going to be a little bit different when you watch this video because it'll depend on the day and the price action of the company. But the price to earnings ratio right now is sitting at about 44%. Let's just call it in the mid 40s. Barrick has a PE sitting at about 17%. So mid high teens. Obviously, that's a little less than half of the PE ratio that you're paying for Agnico. So you're paying half the price. It's kind of like you got a 50% off discount on Barrick Gold if Agnico Eagle was the regular price. But what PE ratios really are you paying more betting on the future of the company? And so if I then look at the amount of earnings growth, let's just say earnings growth, the compound annual rate we talked about earlier, if I just look at that, I compare that with the PE ratio. Well, in Barrick's case, you're paying a 17 PE for a 1.9 earnings growth, compounded every year. It's going to take a while, quite a while, for that earnings growth to catch up to the PE you paid if you bought today. Agnico, you're paying a 44 PE for a almost 19% CAGR. And so, yeah, okay, you're paying double the price, but you're getting 8 times, almost 9 times the amount of earnings growth buying into Agnico versus buying into Barrick. That doesn't sound like so much of a discount anymore. You're paying 4 to 5 times more per earnings growth at Barrick Gold than you are at Agnico. Now, does that mean that trend will continue? Not necessarily, right? These are all backwards looking metrics, looking at the past and guessing about the future here. But just from sort of a fundamental basic analysis here, doesn't look worth it. And again, if any of you know anything about this that I don't, if there's some project coming online or there's going to be a change in the strategy or something that will actually allow Barrick to unlock some of the value that might be here, please let me know. Drop a comment down below. I would love to hear about it. It's a big Canadian brand. It's an iconic Canadian company, and I would prefer them succeed, to be honest. I would love to be sitting here and saying that this company is at a great discount and it's easy money. Doesn't seem like it is. Another thing I want to say, massive shout out for anybody who made it this long in the video. And if you did, if you enjoy this kind of content, please do subscribe to the channel, like the videos. It really does mean a huge amount to me, and doesn't cost anything. And with all that being said, I hope I see you in the next video.